Okay. So the valuation of equity shareholder is different and difficult than the valuation of bond and preference share because number one, the payment of dividend is discretionary in nature. The payment of dividend is discretionary in nature. Payment dividend on ordinary share. Okay. Why it is discretionary? Because the rate may vary, the time may vary, it may be given, may not be given. That is the reason. Okay. And second is it fluctuates and is volatile. It means the dividend. It fluctuates and is volatile depending on the market variation, unlike the interest paid on, unlike the interest paid on bonds and the fixed dividend paid on preference shares. And the fixed dividends paid on preference shares. Done? Okay.
Yeah.
So we move on. So this is the for this valuation we are going to use certain models. First is the dividend discount model, right? Dividend discount model. This is only for ordinary shares. First one is the dividend discount model, and this is something which is based on the valuation of the assets as well. So in case of asset, what you are doing, whatever the cash flow from the asset, you are estimating that, and at the end of the when you are not holding the asset anymore, you are disposing it of whatever valuation you are getting, you are adding up. And remember, you are also affected by the market volatility as well as the risk that is also going to affect your cash flows. This all these are taken into account in case of this different models we are going to write. Okay, right? In this model, the value of the share depends on value of the share depends on the expected cash flow from the share expected cash flow from the share with all considerations with all consideration of the risk involved with all considerations for the risk involved due to the uncertainty of the market due to the uncertainty of the market. So this you need not write, you just can see what is the cash flow you are getting from this equity shareholders, of course the dividend again. Okay, now what is the difference here is, suppose you are a shareholder, you have purchased the share. After a period of time, what you are doing after 1 year, 2 year, you are disposing it off, you are selling it in the secondary market. Now again some other investor is again picking it up. When you are selling with some other purchaser is there, he is again just purchasing the share from the market, again he is continuing for some years, and again he is selling it off. Okay, now when you have sold it off, you have got a stream of dividend payment. At the end, when you are selling up the share, you are either selling it at a higher price than what you had purchased, in which case you have got a gain, capital gain. And if you are selling it at a price lower than what you had purchased, you are getting a loss. So what is the cash flow
No.
you are getting is a stream of income, dividend, and at the end either a capital gain or a capital loss. Again, the next investor who has taken up your share, he is also have the same expectation. Why he has purchased the share? Because he is also expecting some stream of income, and at the end again he is also getting some gain or loss, and this stream continues. Understood? This is for equity
Yeah,
shareholder.
ma'am.
Okay, so let us do. So normally any shareholder, he does not hold it for an infinite period, okay, though it is perpetual in nature. But we know if you are holding it for an infinite period, and when you are calculating the present value of the share, you know it will go down to zero also when you are extending n to infinite. So obviously none of us do that. We go on changing it in the market and there are new buyers. So we are going to value it in terms of the time variation when it's going on for different number of years, instead of changing hand, how the investors are purchasing and selling it. Okay. So here you write the value of a share. The value of a share is thus calculated as the present value, as the present value of the future stream of dividends, of the future stream of dividends discounted at the opportunity cost, discounted at the opportunity cost, including including the capital gain or losses, including the capital gain or losses realized at the time of redemption. Capital gain or losses, that means for any individual shareholder, okay, at the time of redemption. So let us do that calculation. First is we'll calculate the present value of, yes.
Ma'am, actually, how this model is calculating the valuation of ordinary share?
This is what we are using.
We are just we are just buying the share and holding it for
Selling
some
it.
time and taking
Suppose
the dividends
somebody
and
did it at
sell it for
somebody
a
did it
gain
at
or
one
loss.
year, somebody did it after 2 years, somebody did it after 5 years. We are not going to look into that. We are going to look it in terms of n. After n number of years, what is the
Okay.
total valuation of the share? Suppose there were three
Okay. Yeah.
individual in between. Somebody did it at 1 year, 2 years, and somebody did it. We are going to take n as 6 years and then make the valuation. Okay. So we are
Yeah.
going to take the time variation only. So first in case of single period valuation, if it is for 1 year, how to value it? Then we'll just extend it to multi-period valuation. Okay. Right, single period valuation. So in this case, what are your returns? Tell me. What returns are you going to get? If it is ordinary share and it is for 1 year. So what are your cash flow?
Ma'am, the gains or the losses,
At the end,
the
after 1 year, and the dividend for 1 year.
yeah, and that
Isn't it? Okay, so
one
this is,
year dividend. Yeah.
yes, 1 year dividend, because this is for single period we are doing. So can you see the board, Anurag?
Yeah, ma'am, I can.
So in this case, the present value of the bond, this is in case of single period valuation. Valuation of share. So your P0 will be given as, this is your dividend value. You are going to get the dividend for 1 year. Then you are going to get P1, that the share price at the end of that year. Okay. And you are
Yes, ma'am.
discounting it at the given rate of interest. This is for 1 year. So you are going to discount it for 1 year. This is your P0 for a single period. Okay. In this case, your I is your N. N is your 1. Have you written?
Yes, ma'am.
Okay. So just we'll check. I'm doing slowly with small questions so that it get easily known to it. Okay. See, solve it. Suppose he is expecting, he has invested in a share which is giving a dividend of 2 next year, and then he will sell it in the market and the expected price is 21. So if 15% is
Okay.
the discount, you just simply find how much should you pay for the share now. That's the formula given to you. Dividend is 2,
Yes, ma'am.
21 is the price you are expecting after 1 year when you will sell the share. So what is the amount of investment you have done now?
Yes, ma'am. Calculated.
Do it.
Yes, ma'am. Yes, ma'am.
Could do it, Anura. I mean,
Yeah, ma'am.
can you see the board? Not could do it. I am asking, can you see the board?
Uh, yes, ma'am. I can see.
Okay. So this is what you're doing. You
Ma'am,
did,
the answer is 20.
yes, answer is 20. And
Yeah.
this is what you have done. So 2
Yeah,
plus
ma'am. That's
your
what I.
price equal to this. Okay. Now, if I ask what is the return you got on this, what you are going to do? That means you invested 20 and you got how much? After 1 year, what is your valuation you got? The share price is 21. So
21.
what is your rate of return? If I ask what is the rate of return you got?
5%, ma'am.
Yes, very good. So what is your
5%.
yes? What is your yield? How you are doing? This is your P1 minus P0
Minus
divided by
P0.
P0. So in this
Yeah.
case, what you are doing? 21 minus 20 by 20. So you got a yield of 5%. Yield on this is 5%. Okay. And this is the capital gain because you have got more than that. Now this is what we'll write as the rate of growth, G, expected rate of growth. Okay. Expected rate of growth. Done. Now, if you are expecting a growth rate of
Yeah.
G, then we can calculate the share price like this. Your P1 will be your present share price plus whatever your rate of growth, 1 plus G. Go on writing with me. So, if the share price at present is P0, so after 1 year, you're going to expect that it will grow at G rate of growth. Okay. So, from this, we can get your present value of the share as your dividend plus this is your P1 divided by this is your 1 plus I. Already you know the formula. Okay. So
Yes,
in
ma'am.
case of P1, I'm going to write dividend because now P1 is this one. Okay. So go on writing with me. Dividend plus instead of P1, I'm going to write this term. This was your earlier formula. You just wrote previous. Did you
Yeah, yeah.
understand? Okay. So in place
Yes,
of that,
ma'am.
I'm going to insert this.
P not 1 plus G.
Yes. Just
Yeah.
so I'm going to write this is your dividend. It is slow, that's why writing is breaking. Plus this is your P0, 1 plus G whole divided by 1 plus I. This is your equation 2 written.
Yeah, ma'am. Just a second.
Equation 2. Yeah. This you put as equation 1.
Yeah, written.
Okay. Now we'll just simplify. Simplifying, we'll just take the other side and multiply. This is your P0 plus go on seeing your equation so that you understand. And this is your P0 minus this is your P0 into rate of growth. This is your dividend for the first year. This is what you have done. What I do is
Yeah.
take P0 common. This is your I minus G.
I
This is
minus
your
G.
dividend for the first year. From this, what I get that your P0 is simply your dividend divided by this is your I minus G, where I is your required rate of return and this is your required rate of growth, expected rate of growth. You can calculate the same P0 by this. Check it. You have your information. Your dividend is 2, I is 15%,
Two.
isn't it? Dividend is 2
And
in the
yeah.
previous question. Dividend is 2, then I was 15%, and your G was 5%. If you are putting it, what is your P0 you're getting? G is 5%.
Yeah, ma'am, 20.
20. So you got P0 as 20, your answer. Single period compounding. Alternative formula for valuation of your share. If you have done, we'll move on.
Yeah, ma'am, done.
Okay. So we'll go to multi-period compounding. I can share the PPT with you. See the PPT now? Can you see the PPT now, Anurag?
Yeah,
Okay.
visible.
So see, another thing is here when you calculated, what was the answer here you got? 2 dividend and 15. What is the answer you got?
20, ma'am.
20.
20.
Okay. So
Yeah.
how you are going to, we have used this term many times, undervaluation and overvaluation.
Yeah.
Okay. So if the at present market price is less than your calculated present value, remember the share price
Then
is undervalued.
horizontal.
Okay. And if the current market price is greater than the present value you have calculated, then the market price is overvalued, which is very risky. Overvalued means the price will come down in the future. Okay. You just take this term, right? If the market value already you have calculated, the P value is the market value. In fact, you can
Yes,
just
ma'am.
take down the last three lines. The market value of the share should be equal to the present value calculated. I repeat, the market value of the share should be equal to the present value calculated.
Ma'am, in the previous question, right?
No, I'm telling the previous
What
question was
I
just an
have to write?
example.
Yeah.
You have to write this. I
Okay.
just cited this example. Okay, from
Yeah,
which
yeah,
what you
okay.
understood. So this is what again I repeat. Suppose you got 20, okay, and in the market, suppose the price is less than 20, so it is an undervalued share, and if the price is more
Yes,
than
ma'am.
20, it is an overvalued share. This is what you are writing.
Alright.
So current price, given all this information, your current market value should be equal to your present value because you are using all market information. Understanding? So you, when you are
Yes,
calculating
ma'am.
the present value, it should stand at 20 only. If you are saying that the market price is something varying, that means there is some deviation, which is some imperfection is working, which is affecting the current price. Understood? This is what is known as
Yeah.
overvaluation and undervaluation. Right? The market value should be equal to the market value should be equal to the calculated present value of the share, calculated present value of the share at the given opportunity cost. Remember, the opportunity cost is always the market rate you are taking. That's why your present value should match the market value. Okay. At the given opportunity cost, full stop. Then you can just write from here. If the market price of the share is less than the present value, comma, then the share is undervalued. And if the market price is greater than the present value, then the share is overvalued. And overvalued share are always harmful because anyhow the price will again come down. It will crumble.
Yeah, ma'am. Written.
Done.
Yeah.
So again, you just see. So G is representing the present growth rate. So how you already know how to calculate the current market price, which is
Yes,
your price into 1 plus 0. So already you have taken the second formula also. We'll go to multi-period compounding. What is multi-period compounding? Simply extend the n. There's no redemption period.
and we are
Okay, right,
investing
right.
for more than 1 year.
Yes, when the n goes into infinite. Okay, so
Yeah,
no
ma'am.
redemption value is given, right? In case of multi-period valuation, in case of multi-period valuation, the n tends to infinite. Just write in notation. The n tends to infinite, and so the price of the share And so the price of the share will be given as the present value of an infinite stream of dividends. Will be given as the present value of an infinite stream of dividends. Okay, so let us go to the board and show this. You can see the board now, no?
Yes, ma'am.
One writing with me. This is in case of multi-period compounding. So how you are valuing the share? So first is your dividend for the first year, and then you are discounting it for the first year. Your dividend for the second year, discounted for the second year. Continues the last year.
And
This is general formula. This is not multi-period, but it is not for infinite. Okay. So this is for nth year, continuing for the nth year. Okay. So last year you also have a, here you have your redemption value, which is your PN, because you get the redemption value at the end. So if I just write it, this is your P0 is, what you are getting is summation of the dividend values over T period of time, and this is your 1 plus I to the power T, where your T is changing from 1 to N.
T to N. Yes, ma'am.
Okay, and then you have your redemption value, which is discounted for the nth year. This is your equation 1, this is your equation 2. This is already we know something. In case of your infinite N, what is happening is this is going away. No redemption, no. So what you are
Yes,
having,
ma'am.
it is ending here. In case of your where your n tends to infinite, what is happening is this is going away when n is tending to infinite. Have you written this? Can we turn?
Writing, ma'am. Just a second.
Completed, then let me.
Yeah, ma'am. Written.
Written. So now again I repeat, as n tends to infinite, this term will tend to 0, isn't it? When you're dividing it with larger
Yeah,
and
yeah,
larger
ma'am.
n, this will become 0. Okay, so your redemption value becomes 0. So as n tends to infinite, your P tends to 0. So what you have is your P0 will be, that means the present value of your share will be simply the summation of the dividend value over an infinite period of time. Your T is changing from 1 to n tends to infinite for multi-period compounding. This is your equation 3 or 4 something. Equation 3.
Three.
Okay, so we'll take up, if you have finished this,
Yeah, ma'am. Finished.
done. And let's just go back to the PPT. See the PPT, no, Anura?
Yeah, ma'am.
Solve.
Suppose the
Today is 20 and it is expected to increase at a rate of 5% annual rate. G, that means G is given, okay? And the opportunity cost is 15%. But with the price, if it were for 5 years, calculate for 5 years. So this is the example of a redeemable share given. Then we'll extend it to an infinite. Extend the horizon. This is for 5 years given. Take your time, suggest, solve, then we'll move on. Anurag, I've shared it in the WhatsApp.
Yes, ma'am. I'm checking. Yeah, received.
Yes, we'll solve it. The information are given is the dividend. Dividend is 2. Okay. The dividend is 2 there in that question.
Yes, ma'am.
Given? No.
Given, ma'am.
Where? Previous question it was given, not here. But that same question, it continues same question. So your dividend is 2. So can you see the board first, you tell me? Are you able to see the board?
Yeah, I can.
Okay. So if you are calculating the share price now, what are your stream of income?
That dividend and
First is dividend,
the
and remember dividend is going by what? Your this is not a, because this is equity shareholder, it is not a one time calculation. Okay, because each one is again changing. First is your dividend.
you have to calculate, ma'am, year by year, right?
Yes, year by year. First is your dividend, which is your 2, and this 2 is again increasing at what? How, what is your growth rate? 5%.
5%.
Okay, and again your next is your this redemption value. How much it is given? 20. And this 20 after 5 years, it will grow after 5 years, no? So it will grow for 5 years. What is the value you have to calculate? At 5%, it is also going at 5%. What is the value?
Yeah.
Then you bring it to year 0, all this. So your dividend is 2. Second year it is 5% of 2, then 5% of that. For this it goes on for 5 years, plus your this 20 growing for 5 years. This is your 20 and it has grown for 5 years. 1.05 into 5. This has grown for 5 years. Okay, and this is growth. This is 2 or 1.15 is the discount rate. You're discounting it at 5%, 15%, sorry. Okay, next year what will be the dividend? Tell me. Did you understand that,
Um,
Anurag?
yeah, ma'am, I understood.
2 discounted at 15%. Next year, what is the dividend? It will grow by 5%. So what should be the
2
value?
plus 5% of 2 again.
Yes, how much is that? And that you will discount at 15%. This goes on for 5 years.
2.1, ma'am.
Yes, 2.1. So it is your 2.1.
1.1.
And then this is discounted at 15% for how many years?
1.15
For 2
for
years.
2 years. So it is
This
raised to the
goes
power
on.
2.
So you understood. So this is the value of the share at the end. And this is discounted for 5 years. This is how you're doing. Tell me the answer.
That would be a pretty large calculation, ma'am. It would take a time.
Ah, you take your time. More 3 terms only. It is not a large calculation. Again 2.1 growing for 5. Just do the next 3 terms. Take your time, doesn't matter. I'll give you similar sums, you'll solve it once. You can just tell me the terms also. I can just write. 31, what is the dividend? Third year,
Ma'am, it is 2.205.
2.20. Then next year, you will discount it. Okay. Then fourth year,
Fourth year, it is 2.31525.
so it is discounted from the fourth year. And last,
Last one is 2 point. Just a second, ma'am, I'm
do it.
calculating.
So if we do, it will be faster.
It will be around 2.431012.
Correct.
Yeah.
2.43. Discounted at the 15th year. Then what? This is for the 5th year. So this is done. This part is done. Okay. And about this part, 20 growing for 5 years for 5% at 5 years. What is the value? 20 at 5% for 5 years. That means you are calculating only the numerator first. Just calculate the
Yeah,
numerator.
ma'am. Ma'am, it is coming at 2.01. That numerator part.
2.0, how 20, Anura? It's 20, only the numerator part.
Ma'am,
Or it will be 2.0, less than that. You're compounding.
1.15 to the power 5 now. I was
Redo it again. So it will be, let us calculate. How much? 1.05 to the power 5 into 20. How much is that? Quick, I got it.
21.
No,
1.05 into 20.
no, not even 20. I'm writing it properly. This is 1.05 to the power 5. This is what you're doing.
Ma'am, it is 25.5 final.
25.5 is your answer. That means this is your 25.5. Do it, discount it for 5 years. Now you can easily calculate.
Yeah.
Discounting, tell me the value. This is 25.5.
I have to solve all these problems here.
Yes?
Do I have to solve all these
Yes, solve it now.
calculations?
This one sum, do it now. You're just discounting for this different values. 5 times and this one time. It's 5 discounts. Get the summation together of this bracket separately. You can do it at one in the calculator or mobile. You can do it all at once. You don't have to give a break if you go on doing the giving the brackets.
Yeah, ma'am. I'm doing.